So the answer to this question is really relevant purely to the UK, because every market in which we operate has different tax rules. But one of the benefits of the UK is that it's not uncommon for a business owner to own a business for many years and accumulate quite a lot of cash on the balance sheet. So maybe they take out enough money from the business every year to pay for their lifestyle, their house, the car, the holidays, whatever it is they spend their money on. But let's say their business is really profitable and they're making much more than they actually need. If they took the money out of the business as a dividend, then they're going to be clobbered with tax. So it's not uncommon for them to just leave that cash in the business. Now you could use that in a structure in that when you buy the business, let's say you've got a few million surplus to working capital requirements that's in the company bank account, you could include that in the sale. So at completion, what effectively happens is they get paid that money that was surplus on the balance sheet, it's paid straight out to them on completion. But because they're taking it as part of the consideration, if it's structured in the right way, then they're only paying capital gains tax, and capital gains tax rates in the UK at the moment are a lot lower than the you would pay if you took it out as a dividend prior to the transaction happening. So for example, capital gains tax in the UK at the time of recording this is on the first million, it's 10% if you benefit from business asset disposal relief, and then anything over $1 million is charged at 20%, versus you can pay dividend tax between 30 and 40%. So it can be quite significant savings. So there's very good tax benefits of structuring a deal like that. And effectively, from an accounting treatment point of view, what happens is that whatever the surplus cash is, let's say it was 2 million, that's effectively on paper loaned to the SPV, the special purpose vehicle that we used as the buyer. So that effectively then becomes an intercompany loan. That cash is then sent to the business owner as part of the transaction. And then over time, as you own that business, dividends from the target company can be used to offset against that intercompany loan, or it can be repaid. And there are a few other ways that you can structure it. You can create alphabet shares whereby you create a holding company before the deal is done, a dividend is declared up to that holding company, and then the buyer buys that holding company and uses the cash to pay the business owner. So all of that might sound very complicated, and obviously it's very important that when we're structuring a deal that we're working with professional advisors, experts, tax experts and accountants to make sure that it's structured in the most efficient tax legal way as possible. But that's just one way that surplus cash can be used in a deal in UK territories. There aren't the same, not that I'm aware of, there aren't the same sort of tax advantages of doing that with maybe say the US or Australia, but there are certainly structures that can be used to be able to extract that surplus cash in a more tax efficient manner than perhaps taking it as a dividend.